Hey there, everyone. Today on the final bar, the S&P 500 pushing below 4150 as growth stocks continue to lag. Earnings continue to be in focus for us. We'll talk about Meta, Amazon, Intel, and others. Tom Bowley of Earnings Beats live in the studio here in Redmond, Washington. We'll have a great conversation about the charts and signals he's looking at. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cold Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. Investing is never easy, as much as some people might imply it is, and there are times when it feels a little more straightforward than others. I would argue this is one of those times when you sort of quote-unquote earn your paycheck as an investor, right? It's easy to get away with a lot of bad habits during bullish phases. All those bad habits sort of bubble to the forefront when you're in a pullback phase, which arguably we are through the course of the month and through the course of the last couple months, coming off that July-August high. Now we're in the meat of earnings season. We have economic data coming out, geopolitical events continuing to evolve, and certainly the conditions in the Middle East continue to be top of mind for many. At the end of the day, though, why don't we just focus on the trends themselves, focus on the charts, and understand what the market is telling back to us in the form of price, volume, breadth, sentiment, trend, momentum indicators. We'll cover as many as we can today. We have a great guest, Tom Bowley. We've often had him on the show. Excited to have him here in Redmond, Washington, to have a chat about what he's looking at. Let's get right to our market recap. As I mentioned, sort of a risk-off feel through the course of the day. The S&P 500 finishing 4150 or below 4150. Before we get to the charts, though, I want to answer a poll question that we had going recently. Is the next 10% move in the S&P higher or lower? And what's so interesting about this question is a 10% higher move actually takes us, pretty much right back to all-time highs or back to the previous highs in this year. It takes us back to the swing high around 4,600 or so. A 10% down move would actually take us down in that area where we're retesting the previous lows. Let's bring up a daily chart of the S&P 500. Think about what that 10% move might actually mean for us. And by the way, the responses we got from the poll, almost a 50-50 split, a little more 10% lower than 10% higher, 55 to 45%, but arguably evenly split between those two. And honestly, that is in a lot of ways what this market kind of feels like. I feel like there is a sort of a sense of optimism from some investors looking for that bottom, understandably so. Peter Lynch famously said there's way more time spent, predicting corrections and planning for corrections than just kind of, surviving them or something along those lines. But at the same time, we see clear price deterioration. So what would a 10% rally look like? Well, if we would have a 10% move higher, that would take us back up about another 400 points. We call that in the 45 to 4,600 range. That would mean we're retesting July, August. 10% drop if we would continue this trend. If this trend that we're in is just the beginning, 10% lower would take us another 4,410 points. We'll call it. That takes us down to sort of in this 36, 3,700 range. We're undercutting the 3,800 level, which is the lows from 2023, and all of a sudden we're retesting those previous lows. Honestly, I would probably vote 10% higher, although I will tell you that is not a short-term target. I think we probably stay within a 10% range a lot longer than we're comfortable with. When you think about this sort of movement, remember that the market at any point can go one of three directions. It can go up, it can go down, it can go sideways. Think about that third direction and what might happen if we get sort of choppy uncertainty that ends up netting out to a market more range-bound. Perhaps that is what is set up for us here in the fourth quarter. We'll see how the charts evolve. Let's look at what happened today in the markets as we continue on with the market recap. The S&P, as I'm mentioning, sort of rolling over going into the close. The S&P 500 down about 1.2%. That's to 4137. The Nasdaq Composite down 1.75%, down below 12,600. Noticeably, mid caps and small caps actually in the green today. The S&P 400 mid cap index up 0.5%, small caps up 0.3%. So it's not all bad out there. The VIX is pushing a little bit higher here. We've been toying around with that 20 level. And again, as I've mentioned many times, I think the basic back of the envelope assessment is the VIX above or below 20. If it's above 20, that is a high volatility, higher uncertainty, higher fear sort of environment. Below 20 is a low volatility, low uncertainty, low fear, sort of more stable environment, I guess. So the VIX really testing that level for now, remaining above that 20 degree, and I would continue to follow the chart of the VIX for sure. Looking at interest rates, bond markets actually rising today. So while stocks sold off, the TLT, the AG, pushing to the upside. The TLT was up about 1.5%. That means long bond, the 10-year, the 5-year yields all pulling back. 10-year yield finishing the day around 4.85. The 30-year yield back below 5%. The 5-year yield right around 4.8% as well. That is an interesting chart to watch. And in a minute, we'll look at the chart of the 10-year yield, we'll look at the chart of the TLT, and just look at how the conditions have evolved. The trends, I think, very much in play. However, we're starting to see potentially a sign of a reversal here. The dollar, by the way, up about 0.25% today. Looking at the commodity markets, actually mixed. Gold was up 0.2%, silver down 0.4%. The rest kind of up and down. Energy prices rolling over today. The crude oil ETF USO was down 2%. Finally, in crypto land, Bitcoin actually going down. So news for Bitcoin investors. It doesn't just go up. That's what it's felt like here in the last week, as cryptocurrencies have really shown this renewed signs of optimism. Bitcoin, we were questioning if and when it would get above 31,000. Now we've sort of drifted right above there and really accelerated to the upside in the last week. Currently still sitting above 34,000, so we're really at the upper end of the range. We're making new highs for the year, pulling back today, and I think overall the trend certainly appears to be higher. Julius DeKempener, one of our fellow Stock Charts contributors, has done a great job writing some content recently about Bitcoin and cryptocurrencies, and potentially a crypto spring is how he was describing it, maybe further upside to be had from there. Let's finish off looking at sectors, and if you love defensive sectors, you probably feel pretty good today with the REITs and utilities at the top of the list. The real estate ETF, XLRE, was up 2.1%, utilities up 0.8%, materials up 0.7%. If you're wondering why the S&P and the NASDAQ are down, look at the leadership, or I guess the laggardship, the sectors at the bottom of the leaderboard today. You can see communication services, technology, consumer discretionary, 1, 2, 3 from the bottom. And if you think about these sectors and how they're distributed, there's a lot of market cap represented in these bottom 3 sectors. There's not a lot in real estate, utilities, and materials, relatively speaking. So even if all 3 of these sectors had a gangbuster bullish day, it's probably not enough to compensate for the negative move you saw in some of these growth-oriented sectors. Again, sort of moving, continuing to drift lower here on a Thursday afternoon. Let's go back to that chart of the S&P 500, sort of see where things are playing out. We've talked about, and I apologize, I feel like my chart has gotten more and more busy. Someone had mentioned years ago, the busier your chart of the S&P, the more complicated things are getting, right? The more uncertain things are getting, because you're just trying to get a read on things here, drawing lines, you're drawing annotations, and trying to make sense of it. But we've talked about this rotation from, I would argue, a bullish phase into more of a bearish phase, and that's more on the short-term time frame. But very simply, if you look at the trend in the market, lower highs and lower lows, and the way I would describe the goal of an investor at any given point, certainly a technically oriented investor, identify trends, follow those trends, and anticipate when the trends are reversing. That's kind of it. That's the game. And if you repeat that process every day, every week, overall, you're probably not going to be caught too surprised by things, because you'll recognize the rotations as they're happening. So where are we at with the S&P? We're in a clear pattern of lower highs and lower lows. We've now sort of broken down through support today, just the latest down move after breaking down through a key trend line using the major lows over the last 12 months, breaking down through the neckline of this head and shoulders topping pattern, breaking below the 200-day moving average, which now leads me to say, okay, the trend is now down. I'm following the trend lower. So now how can we anticipate when the trend is reversing? And that's when we need to look for downside objectives. That's when we need to look at price momentum to see how that relationship plays out, and look for signs of what I would call signs of accumulation, right? Indications that someone is coming in and buying on weakness. For now, I'd argue you're not necessarily seeing that today. One of the things that came up in our recent mailbag, it might have been in our live Q&A, people were asking about a divergence here, right? Lower lows in price, but higher lows in momentum. And just since we had that question a couple days ago, you could see why I answered it the way I did, which was be careful to sort of label a divergence before the move is over. What's happening is you actually have an active trend, right? The market is going lower. So If, let's say, theoretically, I don't think this is a likely scenario, but let's say the S&P just goes down over the next week to around 3,900, just absolutely tanks. Unlikely scenario, but possible. The RSI would probably go a lot lower because the momentum would be accelerating to the downside. So what looked like a divergence here a couple days ago would look very much unlike a divergence because the trend is still going. So what you want to do is wait for there to be some sort of bottom, some sort of rally off of a low, then look down to the momentum to see if we put in a higher low on the momentum. So for now, I don't see a divergence just yet until we find some sort of a stabilization on the S&P itself. Now, there are so many other things to think about when we're looking at the markets here. And as an equity or ETF investor, I would argue you really need to think about other asset classes and how they're related, what we would call intermarket analysis. Here's the chart of the 10-year yield. And again, just a classic rotation from, arguably sort of a basing pattern, a sideways pattern here from late 2022 into the first half of this year. Then really June, July, into August, we saw the 10-year yield break to a new high. And just like the S&P, lower highs and lower lows, flip that over and you kind of have the chart of the 10-year yield, right? Higher highs and higher lows. So what's happening is the 10-year yield for now, finding resistance around 5%. Today, actually have a bit of a bearish engulfing pattern with the up day yesterday in yields, higher open and then lower close. So you're getting a bit of a short-term reversal indication as the 10-year yield is testing 5%. What's so interesting is if you look at the shape of the yield curve, there are a couple different ways you can sort of describe the shape of the yield curve. This is the slope of the yield curve, which normally goes from lower on the short end and higher on the long end. That's the normal yield curve. Right now we have the inverted yield curve. Because of the Fed raising rates to the degree they have, the short end very high relative to the rest of the curve, but you're starting to see a bit of a normalization there. Now what's interesting about that, the reason why I think that's important to look at, is because one of the best ways to predict a recession has been an inverted yield curve, but it usually doesn't happen until way after the yield curve normalizes yet again. An inverted yield curve doesn't mean there's a recession now. It means there's a recession maybe coming down the road a little bit. And so you're actually seeing the yield curve flatten out or sort of normalize a little bit and maybe getting back to that normal upward slope. Now, depending on how you measure this, it's not as good. So if you look at like the 5-year versus the 3-month point, still not as still sort of an inverted yield curve as we've described here recently, but worth watching to see if that yield curve continues to go higher. If you really want to think about the relationship between stocks and the yield curve, by the way, go to Charts and Tools in the upper left. There's a link on the right that says Dynamic Yield Curve. It's a beautiful, simple, but powerful visualization showing you how the yield curve has fluctuated in previous market cycles. A really good time to go back and review that market history. I want to talk just briefly about gold because gold has actually been going higher. What's so interesting is, we think of gold as a safe haven. I was always taught gold was a safe haven, meaning if stocks are struggling, gold's probably doing pretty well. That has super not been the case here recently, and because of inflationary issues and really because of the dollar in some cases, gold has not been particularly strong at the time when you normally might expect it to be based on equity markets struggling. But in the last month, we've really seen a rotation. Gold got down to around $18.20, $18.25 an ounce. Now it's rotated back and testing $2,000 an ounce. Now that's a key level because that's where we topped out in July. It's also a big round number, which I always think is just important to note because I think that's where naturally a lot of investors kind of take a step back to see whether or not it's worth going above there, but a key level to watch. And if we break above there, there's nothing really left on the chart besides the all-time highs, which suggest gold up in the 2080 to 2100 range. Note how it's overbought. So it's overbought as it's testing support, which generally speaking means to me we probably have a brief pullback. And then if we are going to break higher, that's the trigger to look for maybe a move to all-time high. So keep an eye on the chart of gold for sure. Let's finish off the market recap just looking at some of the names reporting earnings. Meta, of course, coming out. We have a couple names that reported yesterday, and we'll get to some of them if we have time. The reporting after the close today. What's interesting about the chart of Meta, of course, one of those magnificent 7 names, some of those mega cap FANG stocks that have been such a dominant part of the market story in 2023, off of a November low, which actually bottomed out just after the S&P did in October. It's rallied really well, and look at the impressive relative strength continuing from Meta really into October. From now, we actually gapped lower today, but what's really interesting to me is now we're testing key support. And I think one of the things to look at when you have a market in a deterioration phase is look for stocks that are able to hold up. Look for stocks that are actually establishing a support level and not breaking down. Those a lot of times represent an opportunity, not just because they're finding support, because that usually means they're outperforming as well. When it feels like everything's rotating lower, the things that are actually holding up can present good opportunities. That's why areas like insurance names that are still in an uptrend, I think deserve your attention because they're doing well at a time when most stocks are not. So keep an eye on that support. A gap lower, we traded a little bit higher in the afternoon, but for now, appearing to hold that support, we'll call it around $275, $280 a share. Royal Caribbean, and there's a sort of a theme with some of these charts we're going to look at. RCL with earnings, at the end of the day, today was a noisy but not a big directional move. Finished higher about 0.8%. But what's interesting about the chart of Royal Caribbean, in my opinion, of course, it's been downtrending for the last 3 months, but now we're testing the 200-day moving average. We're oversold. And when something is oversold as it's testing key support, that's sort of the red flag goes off in my head of, okay, maybe we get a tradable bounce off of here. So I think maybe cruise lines worth a shot to see if we get a short-term contrarian move. Again, if we're unable to hold the 200-day, that is usually not a vote of confidence in the strength of the name. Paul Tudor Jones, as I've quoted here recently, had said, nothing good happens below the 200-day moving average. So keep an eye on RCL and others. Just to finish off here, a couple names after the close today. We have Amazon, another big name, plenty of market cap, one of the largest names, certainly in the consumer discretionary sector and in a lot of our key benchmarks. You know, the trend up until now, similar to Royal Caribbean, kind of rolling over, lower high, but now testing the 200-day moving average. We're trading after hours now, but as we open tomorrow, I would say, are we able to hold the 200-day in some meaningful way? And if so, there could be cause for encouragement. And if not, could be sort of a problem. We'll look in the after-hours session here. It's popping up a little bit to around 123, so we're kind of midway through yesterday's trading session. For now, after hours, a little less liquid, a little noisier, but worth keeping an eye on to see if it's able to find some upside momentum tomorrow. Intel, very similar. You find a lot of these names have put in a lower high and now testing the 200-day moving average. We'll look at Intel after the close now. And again, these are names that are all reporting here. Intel actually popping pretty well, up about 7% for now in the aftermarket. And again, a lot can happen between now and tomorrow morning, but based on what's happening today, it's actually pushing back higher up toward I think this is the 20-day moving average we're looking at in green, but getting to the upper end of the range that it's been in for the last week. That would be a nice vote of confidence in Intel. Final name, Enphase. Enphase with earnings. This is a name that's oversold. Different one here because this has been an established downtrend. In years prior, we talked about Enphase as one of those leading names in a leading group renewable energy. It has not been the case in 2023. Keep an eye as we're oversold, as we're right around $100 a share. Do we find some footing and bounce higher? As always, pay attention to the earnings bin and look tomorrow to see what sort of follow through we might get. That's a wrap for our market recap. We're going to come back in just a moment with Tom Bowley of EarningsBeats. We'll see you then.
Every year, investors lose millions because they're buying and selling stocks based on headlines, a friend's latest prediction, or social media hype. StockCharts.com offers you a better way so you can relax while you stay on top of your investments. StockCharts.com is the world's leading charting and financial analysis platform. Our exclusive technical alert system allows you to set up your alerts in advance and actively monitors thousands of indicators against every stock symbol and index, so you'll be the first to know when a stock is moving up or down. Build your system and set alerts to buy or sell based on the indicators you care about, not the latest headlines or financial gossip from a self-proclaimed expert. Trade with confidence, because at StockCharts.com, better insights lead to better investing. Start your free trial at StockCharts.com.
Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. One quick announcement before we bring on today's guest, Tom Bowley of EarningsBeats. We would love to hear from you. We're going to do a mailbag show tomorrow on Friday's show, and we'd love to feature one of your questions live on the air. You can get your questions to us a couple different ways. Email is a great way. TheFinalBar@StockCharts.com is the way to do it. Also, of course, on our YouTube channel, you can drop a comment below the video you're watching or just use the live chat feature, which we do have turned on when we're doing a live broadcast of the final bar. Put your questions any of those places. We'll hope to hear from you and hope to answer your question live on the air on Friday's show. I want to welcome on today's guest, Tom Bowley. Tom is the Chief Technical Strategist at EarningsBeats, normally coming to us from South Carolina, today from here in Redmond, Washington. Tom, it's good to see you. How are you?
It is so good to be back. I love coming out here. Love being out here in the studio. I was listening to you, your market wrap, and I wanted to jump in a couple of times.
I saw you were holding back. You were showing some rare reserve.
To this chair. So.
We did have you completely fixated just so you wouldn't interrupt. But no, it's good to see you. And you're bringing back really good memories of ChartCon, which was a ton of fun. And it was a really good opportunity to share a lot of expertise with a lot of people. This is a challenging market. We have a lot of viewers struggling to try to make sense of things. We're seeing things rolling over again going into the close. I know people are interested in where you're coming out on things. We're starting with the VIX. Right around that 20 level, what does the volatility now tell you about the conditions around us?
Well, it's interesting. I actually wrote an article over the weekend, so it's in the article section here on Stock Charts.
Yeah.
So if somebody wants to go in, I did a pretty lengthy article mostly about the VIX. And the one thing you have to understand, I really liked you talking about that 20 level.
Yeah.
Because I talk about that a lot as well. I think when you go above 20, things get really uncertain, and the market can be very unpredictable. It can be down and then come back very quickly. But as long as that stays above 20, I mean, if you go back and look at history, if this continues rising, we can expect bigger and bigger declines. And, recently, even, going back the last few weeks, I would say most of our declines have been less than 1%. But you've seen the last few days, some of those drops are starting to look a little scarier. And that's what happens when you get a volatility index that's moving through 20. And I think this is like 4 closes out of the last 5 that the VIX has now been above 20. So for me, I talk a lot about things below the surface, and I like to try and, soften some of the blows when the market's coming down. Because I am more of a secular bull. I do still believe long-term is up. But short-term, I don't ignore some of the signals that the market sends, and VIX above 20 is one of those. What I would encourage everyone to look at, though, on this chart, because this goes back 10 years, and gives us a pretty good history about this. We've been in a secular bull market for the last 10 years, in my opinion. Some could argue it, but I think, you're seeing mostly higher lows, higher highs, and we continue to push up, as you can see in that bottom panel on the chart. But if you notice, the volatility index still has gone up and achieved some pretty high number. I mean, we've gotten to 25, 30, 40, and in some really panicked moments like the pandemic, you can see that huge one. That's, we don't really see that very often. That's an outlier, but it is very normal to get into the 20 to 30 range on the VIX. And so now we're above 20. We've seen tops in the VIX and bottoms in the market when we're right about this level. If you go back and look, I've got lines, and they get thicker as the lines, in my opinion, get scarier as the market gets scarier. So some of them will stop right at that bottom line around 20 or just above 20, 20 to 25. Multiple bottoms formed. So the volatility index is telling me, be careful. For those who are really, nervous about the market, maybe really need to protect capital. Not the best time to be jumping in, because this market, even though I don't believe it is, you talked about the 10% poll. I would throw myself in that up 10%. I don't believe we're going down 10%. But if this volatility gets up to 25, 30 or above, we could hit that 10% much faster in this kind of an environment than we would in an environment where the VIX is, say, at 13, 15, something like that.
It's so interesting because when you're looking at the chart, I love the blue arrow at the bottom just really shows the long-term trend. What's funny is those times when the VIX has spiked higher, to your point, it usually means the short term is pretty weak. But if you look back, those have represented some of the best buying opportunities in the last 10 years. So in this sort of environment, how do you balance the short-term weakness and investors' tendency to want to run away versus the long-term opportunity that's presented when prices come down to more viable levels, I guess? How do you sort of survive those sorts of periods?
Well, you have to exercise patience, and I'll tell you that's not my strong. It's definitely not my strong suit, because I want to be in the market, but you have to convince yourself when the market is doing what it's doing now. And there were plenty of warning signs back in July that I wrote about and talked about. But the problem is when you see those warning signs, you don't know, is it just going to be a couple of days, maybe a 2 or 3% pullback? Is it going to be a 10% correction? Is it going to be a cyclical bear market? Is it going to morph into a secular bear market? I mean, you don't know when you start seeing some of these signals.
Yeah.
So I think the patience is key, and a really healthy dose of perspective.
Yeah, I love it. Long and is no mistake. We're looking at a long-term chart to try to get some good perspective here. Let's go to your other charts. We have a chart of the NASDAQ. Just thinking, of course, growth has been the story for a lot of this year. Now you're seeing a lot of growth names with earnings, a lot of them rotating lower. What does this rotation of the NASDAQ 100 mean for you?
It means we got problems.
Yeah.
I'm a more of an aggressive trader. I follow the NASDAQ more than I do the S&P 500.
Yeah, okay, great.
Because personally, I like to trade stocks that have a little bit more edge to them.
Yeah.
Than some of the, you were mentioning insurance and stuff. I mean, they're great right now on a relative basis, but I don't go around,
They're not sexy.
No,
okay.
I don't go to my club, after golf and,
Fair point.
I've got myself some great insurance companies. That's not really.
Okay, fair point. Yeah.
But right now I'm just kind of watching the trend. Clearly, I mean, I've got a channel there. You can't argue with price action.
Yep.
And no matter how bullish I might be, I don't argue with breakdowns. I respect these breakdowns, and you can see that right around 14,500, I've got that horizontal line going in.
Right.
That connects the low that we saw back in August, also the low we saw in September. And it's not a head and shoulder pattern because actually the high came in where the shoulder would be back in July.
Right.
But it is a downtrend, and we did have support clearly break here over the last couple of days.
Right.
So when I sent you this chart, you can kind of see right there the way where we finished here, right about where we finished, is down close to that channel line.
Yeah.
And, I was talking to you about an hour before the close.
Yes.
It's like, this is it, Dave. We're reversing.
People should know you accosted me in the Stock Charts Cafe pointing out that we might get a hammer candle.
Yeah.
Yeah. No.
And I said, but it's dependent on the last hour.
Yeah.
And so we rolled back over, so I'm not nearly as bullish as I was an hour
ago.
But I'm waiting for some kind of capitulatory candle. We talked about this a month ago.
That's right.
In the September weakness.
Yeah.
It was like, we need to see something that is capitulatory where we've got a big down move in the morning and then a big recovery in the afternoon. And that's kind of what we were starting at around 1 o'clock Eastern this afternoon.
Yep.
1 to 3, it looked really good.
Yeah.
And then from 3 to 4, we were back down again. So I think we're getting close, and I would love to see one of these candles form, a reversing candle, because we talked about divergences, and I think you pointed out really well. A lot of people do jump in when they first see a divergence.
Yeah.
And that divergence can be eliminated.
That's right.
You can see that PPO or RSI or whatever you're using.
Yeah.
It can go back down below, and then all of a sudden there is no positive divergence.
Yeah.
Here on the on the Nasdaq, even you can see there's still a slight positive divergence with the PPO.
Yep.
There's maybe I don't use the stochastics down at the bottom for divergences because if you go to 0, you can't go below 0.
That's
so
fair.
you're always going to have a positive divergence. But I think on this chart, what it's telling me is that we're definitely have to respect this breakdown.
Yeah.
We're getting close to that channel line, and if I could see a reversing candle with a slight positive divergence here, which I think is a little bit more pronounced on the S&P 500 chart, if you want to go and pull that one up.
Let's do it.
So if you, right up the top, so I'd have to draw the price line down a little bit, but you can see it's a little bit more pronounced on the PPO. So if we could get a reversal here, some kind of reversing candle, it helps me on a couple of fronts. Number one, it gets you the price reversal. It actually gets you some buying in the afternoon. And we were talking about this before the show. You get a lot of action where we're seeing everything going down into the close. That's not a good feel.
That's right. Yep.
So if we got a hammer candle or doji or something like that, or even a bullish engulfing, something like that, at a bottom with a positive divergence, the beauty of getting in is that the low on that reversing candle can serve as your exit.
As your stop or as an exit.
So you don't have to marry into it, but it starts to give you some signs. So that's what I've been waiting for, and I've been telling EarningsBeats folks for the most part. We got to have patience in this market.
Be patient, still waiting for capitulation.
Yeah.
Now, further on in this chart, you were talking about some of the things that are not breaking down. Some of these ratios, what do these represent in terms of the market structure?
Well, I like to follow growth versus value or aggressive versus defensive, offensive versus defensive. And so these panels down below, I've got the QQQ relative to the spider. QQQ is a little bit more dependent on those growth names. That ratio is still going higher. Market's been coming down. That's unusual. And if you go back to the 2022 cyclical bear market, it was totally opposite. These growth stocks were getting hammered when the market was going down because Wall Street was bailing and they were rotating. I'm not seeing it as much here. XLY versus XLP, that is a ratio that I like to follow, and that's probably my favorite ratio. And we are seeing a slight break on that one. But the next three are all growth versus value, large cap, mid cap, small cap. So this isn't just the FANG stocks.
Right.
We're seeing growth across the board at all, the three different asset classes. We're seeing growth outperform. And that makes me think that this isn't going to last.
Yeah.
And that's why I'm on alert for some sort of, some kind of reversal, some capitulatory move where I can take a little bit more of a risk approach to the market, which right now I'm just kind of trying to stay away from.
So in this sort of environment, when you get that idea that short term the trend appears to be lower and you're looking for that capitulation, how do you position yourself in this kind of environment? Do you like to do sort of an all cash, take risk off and just wait? Are there areas of the market where you are seeing opportunity, where you think despite the market weakness, you still want to be in sexy insurance companies or whatever? I mean, how do you sort of manage through this sort of environment, which is uncertain?
Well, again, I think it comes down to each person's strategy
Sure.
and what you believe.
Yeah.
I believe we're in a secular bull market.
Yeah.
If I thought, like at the beginning of 2022, when I started seeing this weakness, I had a ton of signs telling me we could morph into a cyclical bear market.
Yeah.
So going into that market, it was definitely cash.
Yep.
And then even when things started to break down, there were shorts. And I don't like to short generally in a secular bear market or a secular bull market.
Sure.
But when we get into something that appears to be longer in term in nature, in
Yep.
terms of a cyclical bear market, then I will take a few more chances there. But right now, I'm either cash or I am following the indexes with an ETF, either the IWM, which actually I kind of moved away from that the last few weeks because it's really broken.
It's been struggling.
It's been really hard.
Yep.
But the IWM is getting very close to a key support, and we won't go over it here, but 160 is a major level on the IWM, and I think we were down around 163 today.
Yeah.
So that's something to watch. But for me, it's just cash and or maybe ETFs that are tracking the major indices, and I'm okay riding it down some.
Yeah.
Because I like to be a little bit more aggressive, and when we are trending up, I start looking for the leverage ETFs to kind of add a little juice to returns.
I got it. So sort of get more benchmark oriented, sort of take the risky bets off, and then you're ready when things start to rotate. Put those more into opportunities.
I was ready to pounce this afternoon. I really was.
It's not to be, okay? So, but we'll keep waiting with you, Tom. Listen, awesome to see you. Thanks for sharing some charts with us. Really appreciate your perspective here. Thanks for coming to Washington State. It's great to see you again.
Great to be here.
Pleasure to have you in the studio as always.
Yeah.
That's Tom Bowley. Tom's the Chief Technical Strategist at EarningsBeats, again from South Carolina, but again, really excited to have him visiting us at StockCharts HQ in Redmond, Washington. Folks, we've got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. S&P 500 Fibonacci structure. This is a chart that I actually had set up about a year ago. I was looking at the 2000, 2021, 2022 sort of rotation. I started looking at sort of longer term Fibonacci levels just to get a sense of the structure here. And I updated that just earlier today to show where we're at relative to where we've been. And if you look, here's that run from the October 22 low up to the high around 4,600 in July into August. We've now broken down through that first 38.2% retracement level, which means if you're thinking of downside targets, 40.50 would be a 50% retracement, 39.15, 3,900 and change would be a 61.8% level. I'm eyeing this pink 3,800 level because that would be a big 38.2% retracement of this entire rotation lower, and arguably that's what that whole 2022 low was sort of bouncing around. Now, the question of whether we get from here to there is, I would argue, all about the price dynamics over this period, right? Do we continue to see these trends in place? Do we see a lack of capitulation? I just put a video on my own YouTube channel called Market Misbehavior where we focused on some downside targets in the S&P and how they're derived. So make sure you check that out if you missed it. Chart number 2, Microsoft. A lot of earnings and too many for us to go through in a 30-minute show every day, but certainly use our earnings calendar on stock charts, focus on some of those names on the move, and think about what the charts can tell you to understand the dynamics leading up to announcement, and then think about what they tell you afterwards. I'm struck by a chart like Microsoft gapping higher on the earnings release, which on the surface seemed pretty constructive, right? Talking about cloud computing continuing to be pretty optimistic, but traded lower through the course of the day today, giving back all of those gains from that earnings win. So when stocks gap higher, but there are no willing buyers coming in, I think that tells you a lot about the market conditions for now in the short term. Certainly seems like buyers are not jumping at the opportunity to own a Microsoft. Finally, I'm going to light it up with a sexy insurance name, Assurant. I was asked on a podcast earlier this week, what's a name that comes to mind as in a good opportunity. And I struggled for a moment and I threw out AIZ off the top of my head because I'm thinking, what's something that's not going down? And as funny as it is, we talk about something like insurance, which is not a space that a lot of people are excited to talk about. It is an area of the market where the charts are going higher. It's an area of the market where they're outperforming on a relative basis. And Tom Bowley here in the studio with me used to tell me, if you want to outperform the S&P, you need to own things that are outperforming the S&P. So as always, let's focus on the relative strength. Improving in this space, the momentum overall is strong. And so charts that are working, I'm inclined to follow those as those trends continue. Get nervous when those trends of higher highs and higher lows stop being the rule. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. A special thank you to Tom Bowley of EarningsBeats joining us here live in the studio in Redmond, Washington. It's my daughter's 16th birthday. Happy birthday, Zoe. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.